Hello, my name is Ed Wood, and I'm going to talk about 1 to 4 unit investment property financing today. I started doing investment properties back in 2002 as a loan officer with a mortgage banker, and so I've done quite a bit of these and have a lot of experience in doing investment properties. I do hold a California DRE broker's license as well as a national mortgage license individually and as a company, my company CPL Mortgage. Let's get started. Okay, we're going to cover the loan limits, qualifying, required documentation, what determines the interest rate for investment property, and also rate shopping, where to get your best deal. There's a couple types of loan limits. There's a dollar limit, and there's a loan to value or percentage of value limit. On a single family, I think we all know 417 is the conforming limit, and that includes investment property and second homes. What a lot of people don't know is the conforming limit increases the more units you have. So a 2 unit is 533,850, a 3 unit is 645,300, and a 4 unit is a whopping 801,950. And your loan to value limit, single family, is 80% loan to value. 2, 3, and 4 unit are all the same at 75% loan to value. Let me example here. If we have a 4 unit and we did 25% down or had a 75% loan, we could actually go out and buy a 4 unit 25% down for about $1,050,000 and have a loan amount of $801,950, and that's at a conforming rate. So you can see how you can really have some purchasing power out there, refinancing power to pull cash out on these 2, 3, 4 unit properties. Here's a simple formula for calculating the loan to value. Also note, and we'll bring it up again on a few slides here, the lower the loan to value, the lower interest rate. So if we had a 50% loan to value on this 4 unit, we get a much better interest rate than we would at the maximum 75% loan to value. Alright, qualifying. You're going to need a minimum 620 FICO score. Qualifying is similar to qualifying for an owner-occupied loan. It's very similar to qualifying for your primary residence, single family. They take your income, and they take your liabilities, and they get your debt-to-income ratio, and that's how you qualify. Plus, of course, credit and other stuff like assets, things like that. The subject property's net cash flow can be used if the borrower has a 2-year history of managing 1 to 4 unit investment properties. This means exactly what it says. If you have a history of owning and managing 1 to 4 unit investment properties, you can use the income. For example, if you're purchasing a property, you can use that income on the property to help you qualify and add that to your income to qualify. Same with refinancing. If you bought your property a year and a half ago, you're not going to be able to use that income to qualify. But if you bought it 2 years or greater, then you could use the income from that property to qualify for the loan. This used to be 6 months reserves. It used to be 2 months. They have boosted up in the last few years, and so you're going to need 6 months reserves. So if your payment is $2,000 a month, take that times 6. You're going to need $12,000 at the close of escrow, just sitting in an account. So in addition to that, if you own additional properties, you're going to want 2 months reserves on each additional property you own as well. The borrower cannot have individual or joint ownership in more than 1 to 4 unit properties that are financed, including the subject property. I do have programs up to 10 properties. Rates aren't as attractive. There's limits on cash out, if any cash out. So the guidelines are quite a bit tighter. But for your best rate you can get, you're going to be at no more than 4 properties, including your primary for that. And this includes if you're on title but not on the loan on properties. So let's say I have 2 properties myself, I'm on the loan and I'm on title, but my brother has 3 properties. I'm not on the loan, but I am on title. That would count 5 properties that I own. So you got to be careful with that. Alright, documentation. Standard 1003 mortgage application like we see every time you do a loan. Most recent pay stubs covering 30-day or P&L if self-employed. So you need most recent pay stubs covering 30 days and a profit and loss if you're self-employed year to date. Last 2 years W-2s and 1099 forms. Last 2 months statements for all checking, savings, retirement, and investment accounts. Include all numbers, pages. Don't just send in the front page of your bank statement. It's going to have to be all pages, including back if you have anything on the back of your statements. Last 2 years federal 1040s signed, including all pages. So you got to make sure you sign them. You got to include all the pages. If you're self-employed and you own a company 25% or more, You have to send in your corporate returns. You have to send in, if it's a partnership, your partnership returns, your K1s. Let's see, an LLC. So any company, you have to send those returns as well if you own 25% or more. Copy of Social Security card and driver's license. This is Patriot Act, done a few years ago, so we do have to have your Social Security card. So if you don't have it, might as well be prepared to get it. These days they need it for doing mortgages. Or driver's license or a government photo ID is fine. So, and we also use this to verify the Social Security number because numbers get transposed. So we want to verify the Social Security number when we pull credit to make sure we're pulling the right credit report. Alright, next. What determines the rate? The first thing that determines the rate is the program. Is it a 30-year fixed, 15-year fixed, or an ARM? I think we all know that 30-year fixed is a little more than an ARM, or a little more than a 15-year, and an ARM is less than a 15-year as far as rates. Purpose: purchase, refinance, cash out, refinance. Purchase and refinance, there's not an increase in the rate, but a cash out refinance, there's a bump in the rate. Loan to value, like we were seeing on the second slide. The lower the loan to value, the more improved rate you get. Impounds. Some people don't realize this, but if you choose impounds, you'll save a slight amount on interest rate. So a lender is willing to give you a better rate if you let them make sure the taxes and insurance are being paid. FICO score. The higher the FICO, the lower the loan. The higher the FICO, the lower the interest rate. I think we all know that. Occupancy. Primary, second home investment. Currently, second home and investment are considered non-owner. There's the same adjustment right here, and we'll get to another adjustment again on investment property. But this is the same adjustment currently than a primary. Lock period. If you go with a 15-day lock, your rate's going to be a lot less than if you go with a 90-day lock. So we play the market a little bit, and generally you're better off floating and locking right before we draw docs, taking advantage of that short lock period rather than paying a higher interest rate for a longer lock period. Property type: single family, condo, PUD, 2 to 4 units. This is going to be your highest adjustment. This is why when you call and you get a quote, the very reason why investment property rates are higher than a primary interest rate, because you got 2 hits: investment and then 2 to 4 units if 3 units. Single family and condo, there's some adjustments here, but not as big as the 2 to 4 units. So bottom line here, these adjustments are, if you start out with a base rate of, say, and I'm just throwing one out there, it's not today's rate, at say 4%. And let's say 4% was a 30-year fixed, purchase, 50% loan to value, impounds yes, FICO score 760, which 760 is the new high FICO. It used to be 720, so that has increased in the last few years. Occupancy, primary, lock period, 15-day, single family. That would be your least amount of risk. The more risk you add, the higher interest rate you get. So you could be, say, a 15-year cash out refinance, 75% loan to value, no impounds, FICO score, say 680, occupancy investment, lock period 90 days, property type 4 units. You're looking at 4 7/8 rate. So you're looking at almost a full percentage rate difference because of the risk factor changes. So, alright, let's get going here. Rate shopping. There's 3 places you get money, and you've got banks. I think we all know banks. We all know direct lenders. We hear their ads on radio. And then, of course, Ed Wood. Now, the difference in these 3 ways to originate a loan, or the retail outlets for loans, is a bank has one program. They have their own program. And it's not like you're going to call a loan officer, give him your loan paperwork, and he's going to call you a week later and say, hey, this other bank has better rates. I'm going to submit your loan through them. Obviously, it doesn't happen, so you're dealing with one program. You're dealing with much more overhead. There's a higher demand, so the rates may not be as attractive because the convenience of walking into the bank, you already bank there, so there's a lot higher demand. People think the money's better there, I think, or greener or something. Less disclosure. They're regulated differently, so they don't have to disclose as much as, say, I would. Most loan officers don't understand non-owner occupied property or investment properties. You call up a loan officer there. They generally work on single family primary residence loans. I've known there to be a lot of mistakes done. For example, the 4 property limit And let's say you call it and say, hey, I have 16 properties. They go, fantastic, let's send in all the paperwork, let's get it going. And you have to call them in 2 weeks because they haven't called you yet. And you find out that the limit's actually 4. So little things like that, it might take you days to put together a file, and then in 2 seconds it's just, you find out you don't have a loan because of some parameter. So, and on top of that, they might want to take the next phone call. Your phone call is a 4-unit investment property finance, and when they can take the next 10 phone calls in their single-family residence owner-occupied loans that are slam dunk easy, they want to sit there and work on a very difficult loan, or do they want to do 10 loans that are easy? So, okay, direct lenders, they have a few programs. They actually generally fund off of what's called warehouse lines, so they're really close to broker. The only difference is they underwrite. They do have different compliance, and they are regulated differently, but they generally fund off of a warehouse line, which they're paying interest on, and then they sell a closed loan, one that's been funded in their name, and they sell it to whoever. This is why if you've gone through a direct lender, in a few months you find that it's with a totally different bank or other lender. Less disclosure, they are regulated differently, and larger overhead. Because they are funding their own loans, they have a lot of compliance, they have to house these people to underwrite and process and administer and everything else. So that's the direct lender angle. Ed Wood, I have a very low overhead. It's just me. I got a small office. I have a processor, and we just provide good rates and good service and just knock out the loans and get them done and on to the next one. More disclosure. I'm regulated, again, differently, and so I have different disclosures. Experience. I've been doing it since 2002, and more importantly, investment property since 2002. And by the way, I've got some great jumbo programs as well, so up to $3 million. So I've got the experience that maybe a bank or some other loan officer might not have. More options. I can actually, the example I gave you with the one program with the banks, I can actually take your loan on the wholesale mortgage market, find you a great rate, find you a lender that's going to match your needs, for example, up to 10 properties. So we'll find somebody that can do your loan generally. There are a lot of restrictions. There's no stated programs anymore or anything like that. But if it can be done, I can find it to get it done on the wholesale mortgage market. Convenience. Because we have more options, and I can take your loan package that you do one time and have the ability to send it to a lot of different places. You don't have to. It's convenient. You don't have to, do a loan with one bank, find out it's declined, then go gather all your paperwork again, do a loan with another bank or another lender, and go through this huge process. So it's more convenient. Anyway, let's keep going here. This is my contact information: 714-786-5431. Of course, you can reach me by email at ed@edwoodbroker.com. I'm also on Facebook at edwoodbroker and Twitter. So hope to see you online, or shoot me an email, or give me a call. I love talking shop about investment properties. Happy to give you a quote. And also on the website you'll find, I think I list maybe 100 banks and credit unions. So you can shop till your heart's content, and then give me a call, and so I can quote you and see if we can save you a bunch of money and make these properties cash flow too. So I look forward to your call. Thank you very much.